Susan, I've been learning about facultative reinsurance, especially for commercial property. Can you explain how it works?
Sure. Facultative reinsurance is used for individual policies where the reinsurer evaluates each risk separately. Unlike treaty reinsurance, which covers a portfolio of risks automatically, facultative reinsurance allows the reinsurer to choose whether to accept a specific risk. It's often used for large or unique commercial properties where the insurer doesn't want to keep the entire risk.
So, it's not automatic, each risk is reviewed individually?
Exactly. For example, imagine an insurer is covering a commercial building valued at $200 million but can only retain $50 million of that risk. The insurer may cede the remaining $150 million to a reinsurer who will assess the building's fire protection, construction type, and location before deciding to accept the risk.
And the reinsurer can decide not to take on the risk if they're not comfortable with it?
That's right. Facultative reinsurance gives both parties flexibility. The reinsurer reviews the details and can reject or accept the risk. If they accept it, they'll take on a portion of both the premium and any claims that arise.
How does the premium sharing work in this case?
Let's say the premium for the building is $500,000. If the reinsurer takes 75% of the risk, they would receive 75% of the premium, $375,000, and be responsible for 75% of any claims.
Are there specific risks where facultative reinsurance is common?
Yes, it's often used for shopping malls, large industrial facilities, or stadiums. These high-value properties have significant exposures, like fire or natural disasters, that insurers might not want to handle alone. Facultative reinsurance helps spread those large risks.
Can you give an example of a mall that might need facultative reinsurance?
Sure. Say a shopping mall has multiple restaurants, increasing its fire risk, and it's valued at $300 million. The insurer might keep $100 million of that risk and use facultative reinsurance to cover the other $200 million. The reinsurer will evaluate the fire safety measures and other factors before agreeing to take on that $200 million.
So, the reinsurer evaluates each unique risk before committing?
Exactly. Facultative reinsurance involves more detailed evaluations, which makes it more time-consuming and sometimes costlier than treaty reinsurance. But it provides flexibility for managing large or unusual risks that don't fit within standard portfolios.
It sounds like facultative reinsurance is used when a risk is too large or complex for the insurer to handle alone.
That's right. It's ideal for one-off risks or properties that aren't covered by standard treaty reinsurance. For example, a large manufacturing plant might need facultative reinsurance due to the higher risk involved.
It seems like a valuable tool when insurers face larger or more complex risks.
Exactly. Facultative reinsurance offers flexibility in managing risks that fall outside typical portfolios. You'll encounter it often, especially when dealing with high-value commercial properties.
Thanks for the explanation, Susan. I understand now how facultative reinsurance works for commercial properties.
I'm glad it's clear. Understanding facultative reinsurance will help you make better decisions when managing large, unique risks in your underwriting role.